The more that you build, the more income that you attract, the more assets that you attract, you start attracting a higher tax bill. The problem with not talking about taxes is that if you don't explore it and you don't monitor it on a periodic basis, what could end up happening is that the amount of taxes that you pay can start getting out of control. I do actually share effective ways to minimize your taxes that can save you hundreds, if not thousands of dollars for free. I know the last thing you want to hear when it comes to money leaving you are taxes, and I get it. The subject is controversial, it's confusing, and its complexity makes it an overwhelming subject that you may not want to talk about. You probably feel powerless when it comes to dealing with this. And so what I'm about to share with you are going to be concepts around personal income taxes, and it's going to be woven together with practicing the process of becoming your own banker, the infinite banking concept in Canada. Now, if you really want to learn more about this process, make sure you visit watchibc.com for a free 90-minute training on this process. And for you to get some more clarity on the process of banking and how you can take control of the banking function as it relates to your needs, I want to recommend that you get a copy of this book, and we've left a link for you to get a copy of it. When you go through this whole video, you'll find ways that you can optimize your taxes to keep more of that money with yourself. So the next logical step is to minimize and keep the amount of money that you've had from attracting more taxes. And so this is where the concept of becoming your own banker will make more sense to you. So when it comes to building your wealth for you and your family, the more that you build, the more income that you attract, the more assets that you attract, you start attracting a higher tax bill, whether it be today or in the future. And what I want to make sure that you know that taxes is a really multifaceted and dynamic discussion that you want to be able to have with the right people on your team to help achieve your goals and objectives. Hey, I'm Henry Wong, a CPA, CA, and authorized infinite banking practitioner in Canada. I've actually spent years helping clients and teaching other CPA, CAs on helping their clients optimize their tax efficiencies in all walks of land, whether it be real estate investors, financial market and cryptocurrency investors and traders, and business owners. The problem with not talking about taxes is that if you don't explore it and you don't monitor it on a periodic basis, what could end up happening is that the amount of taxes that you pay can start getting out of control. Canadian income taxes are defined by the Income Tax Act, and in that act, there are certain areas that are open to judgment. There are also certain areas that if you're not monitoring your taxes paid and you allow the default rules to be applied, you could inadvertently overpay your taxes. And that's not something you probably want to do. Also, if you don't monitor some of your expenditures in your life, you could be missing out on the reimbursements of taxes that you should be receiving. So the purpose of this video is to share with you some helpful information so you can take an active role in controlling and minimizing your taxes from your flow of money. Now, what's really important is that the Income Tax Act is very complex. And like I mentioned, it's subject to interpretation. And it has to be applied to your specific situation and circumstances. So you can appreciate that this video will be long, and you'll appreciate that because of how complex taxes are, it's impossible to cover every single thing in one video. What's really important to understand also is this video is meant to give you an overview of the income tax system. And it's not complete, and it's generally going to be basic. But I think it's really important for you to know about how the income tax system works so that you can find ways to detect opportunities and work with members of your team to help you make sure that you can optimize your taxes. Now, what's also important is my opinions may differ than someone else. You may have nuances that others may not have. And the key here is you are only gathering information to form your own opinion. Please make sure you talk to a tax professional when it comes to your specific situation and circumstances. The last thing is please make sure you stick through watching this video because I do actually share effective ways to minimize your taxes that can save you hundreds, if not thousands of dollars for free that others may actually charge you. So that should be at least worth your attention. Personally, I'm just going to say it's probably questionable whether the CRA understands the complexities of the Income Tax Act that they've created since the beginning of time. This content isn't meant to be digested all in one sitting, so make sure you watch it multiple times in multiple pieces, because there will be new things that will just be coming up in your mind when you are able to digest the volume of content that is being shared. So when it comes to saving thousands of dollars of taxes, well, I'd say that's pretty worth it. You've spent years learning something valuable to make money, so why not learn something valuable so that you can open a discussion to potentially save hundreds, if not thousands of dollars. Let's move on to taxes. When it comes to individuals, it's really easy to be misled into thinking that income and payroll tax deductions that are subtracted from your paychecks are the extent of taxes that you would be paying. And that's actually a mistake. To understand the full cost of taxation and the burden on you, you have to consider all of the taxes, both visible and non-visible or hidden. These are taxes that you pay throughout the year to the federal, provincial, and municipal governments. So let's take a look at what those taxes are. This is a research study that was done by Fraser Institute back in 2020, and it includes a breakdown of a total tax bill, and it's based on a family income of $115,753. And if we kind of look at the breakdown of the total tax bill, so an individual family, so a husband and wife or two common law partners make about $115,753. And if we look at the burden of their income that they've earned, 12.5% of that goes to income taxes, 9.1% goes to payroll and health taxes, 4.9% goes to sales taxes, property taxes are 4%, profit taxes are 3%, sin taxes like cigarette and alcohol is 1.5%, fuel, vehicle, carbon taxes 1.4%. Again, this has increased actually in 2021, 2022. And then other taxes of 1% and import duties of 3%. So the total weight of that 115,000, the amount that they pay towards taxes is 37.7%. If I were just to pull up a very quick calculator to show you how much taxes that family pays, so of that 115,753, 0.377 or 43,638 goes to taxes for this family. And that's kind of very eye-opening because in Statistics Canada, the general average salary for a Canadian approximates 45 to 50,000. So that just kind of puts into context that as a general family who's making 115,000, about 44,000 in the overall encompassing aspect of taxes is paid, almost equivalent to the average salary in Canada. So this is very, very eye-opening for you, just so that you can understand and see. That's a very big portion of your income. It's actually more than a third of it. So again, this is very, very important to understand in terms of the magnitude of how much taxes you are actually paying. The other part to really take away is that 44,000 in taxes families pay can actually be more than the proportion if they have their basic needs. So they could pay more taxes in terms of in the dollars of taxes compared to their actual basic needs like food and other supplies. So there are many times when I work with clients where their actual cost of living for basic necessities are actually less than what they're paying for taxes. So when you're in that situation, you are right to wonder whether you are getting the best value for your tax dollars, because all of these taxes add up and make your family's total tax bill, which is quite expensive. So we have to look at the situation from your perspective. When you look at it from the context of your personal money flow, what this research shares is that for each $100 of money that flows into you, $38 that flows out of you goes to the government. Of course, taxes fund important government services, but we shouldn't simply assume that higher taxes always provide better government services. If you look at our tax code, it's actually really complex. And it's a worthwhile question to wonder how much does it cost to even fund the salaries and departments to administer this complexity and these tax rules. How much does it cost to fund the programs and keep the programs, and whether or not they are even relevant? While these are some circumstances you can't control, there are certainly some that you can, and this is why it becomes important to look at where you can to build your personal family wealth. So what I'm going to focus on in this video is the largest portion, which is the 12.5%, according to the study, your personal income taxes. Before I dive into that, let's take a step back and look at one of the components of personal income taxes, which is actually called employment income. And one of the things we do here at Ascendant Financial, and as a coach to my clients, it's really important to get clarity on the flow of your money. You've got to have clarity with how money is flowing in and also flowing out of your life, and taking control of the banking function as it relates to your needs is a big part that you need to grasp for building your reservoir of wealth. This is why becoming your own banker is an important concept to get a grasp of. So let's look at an example for a job. You are exchanging your time, your experience, your knowledge, and or your labor for a contract which states how much money you would be paid. You agree upon those terms on how you would be paid, and that money is the inflow that is coming to you in the form of a paycheck. Unfortunately, you don't actually receive that full amount of money. From that paycheck, a portion of that money has already flowed to the government first before it actually flows to you. By design, it is told that it's more convenient for you, and rules are put in place where if you don't pay your taxes on time, there will be penalties and interest. It's also important that when it comes to owing someone money, the act is written to essentially discourage that you leave money owing to the government, because the penalties and interest can be quite severe. At least for me, I find it peculiar that the government designed a system to receive their share of the money before I receive it. The first assessment for you to look at is in terms of the design of the system. Who was it designed for? Was it for you, or was it for the government? Let's take a look at first the history of how this tax system got started. When we take a look at the history and also look at the possible understandings of the behavior of what was happening during that history, we can learn from those similar behavior characteristics. Now, straight from the CRA's website, they share a history of the taxes and the story of income taxes and how they came to Canada. Well, Canada was a British colony and joined Britain's side in World War I in 1914. And the pressures of financing the war resulted in increasing customs and excise taxes. And in 1916, the federal government began collecting corporation tax. And this part is key. As a temporary measure to help finance the war, the federal government introduced the Income Tax War Act, which covered both personal and income taxes. And straight from the CRA's website, there's a quote from Sir Thomas White, who was the Minister of Finance at the time, that said, "I have placed no time limit upon this measure. A year or two after the war is over, the measure should be reviewed." Now, after the war ended in 1918, the government still needed to pay for its war-related expenses, such as veterans' pension, debt interest. So in 1920, the federal government introduced sales tax, which you now know as HST and GST, but to fund those shortfalls in spending. Well, by 1948, so this is pretty much after World War II, income taxes was no longer considered temporary, and the Income War Tax Act was replaced with the Income Tax Act. So what was initially a temporary measure implemented during a crisis became permanent. You see, ultimately, taxes are a revenue source for the government. The government is and will incur expenses. When expenses are much higher than their revenues, the government goes into debt, and at some point, the money that they're borrowing to finance their spending will need to be paid back. So it's important that you look at the current economic environment and the financial position of the government. That can bring leading indications to know what could likely happen. First, are they continuously in a deficit or a surplus position? When the revenue source isn't enough to cover spending, then collecting more taxes, which is increasing the source of revenue, which they get, is a primary lever that the government has. And so when it comes to income and how it gets taxed, now it's really important to understand the sources of income that you have, which actually can be broken down into these common categories. The first, and by virtue most popular one, just because of the population, is called employment income. And so this includes salaries, bonuses, wages. These are all taxed when you receive it. Signing bonuses and non-competition payments are taxed when received. Gratuities, tips are also taxable as employment income. Taxable employee benefits and other income, which includes items like interest income. The next category is called capital gains. The next category is dividends. And then the last category is income from being a proprietor or your properties like real estate. So that's generally the four categories that you want to think about when it comes to your income. Now, when it comes to your source of income, these are actually essentially captured from the party who pays that income. And also you as the recipient of that income would also capture it. And how is this captured by the CRA? It's actually captured through forms. So in terms of the most common income types, sources that you receive, you would receive these most common forms. Like when you get paid as an employee, you would receive what's called a T4 remuneration slip. So this is quite common for you to receive. And if you are a proprietor, you would actually receive generally a T4A. And then all of these other forms that would generate income, these are very clearly captured by the paying entity or paying entity, and then you as an individual would receive that these forms. So it's very generally very clear cut. What someone pays is reported to the government, and then what's received by you is also going to be reported by the government, so that they have that visibility of that exchange. So this is actually really important to understand, because there's generally very little opportunity for mistakes to happen in certain areas where forms are equally filed and reciprocated. Now, the next part I want to also clarify are due dates. The next point I want to clarify is the due dates when it comes to your taxes. Personal. Your taxes are determined by your income earned during a calendar year. Using specific examples is from January to December, in this case, 2021. So by the end of December 31st, that's what would be captured in what you would report to the CRA. So after you've captured all of the information from the various forms, they're typically going to be entered into a document that is, in essence, formatted in a way that the CRA understands and how it processes it. Once it gets sent off to the CRA, this is considered filed. And of course, there's a lot of income tax softwares and providers that, organizes this from how you receive the forms, which you pass to do either yourself or to a professional, that then gets organized in buckets and box numbers and line numbers, ultimately gets sent to the CRA for them to recognize those matching areas. And so what I want to share with you is that personal taxes are required to be filed and paid for by the following year of April 30th. If you or your spouse are self-employed, then there's a little bit more time given to you, as your tax returns are actually due to be filed by June 15th. Now, what actually tricks many people is that if you owe taxes, the amount owed from January to December has to be completely paid off as of April 30th of that following year, not when you file it by June 15th. That's a little bit weird, right? Like, you basically, in order for you to pay your taxes, you actually have to know how much you need to pay. And for you to know how much you need to pay, you actually have to have filed it. So remember, who is the system designed for? It's for the government. They want to make sure that by April 30th, they want to make sure that they've collected their source of revenue in time for them, right? The other part to also recognize is if you owe too much taxes, I'm not going to go into the complexity here, is that you have to make what's called installments. And these installments are calculated on certain predefined formulas that you, of course, at this time, should definitely talk to your tax professional to know how that process actually works. What happens if you're not following the system? Again, the system is designed for them. And when you're not following the system, they're going to impose penalties, whether you like it or not. And so here are those consequences for not following the system. So the first consequence is if you file a late return. If you file a late return, they're going to impose a penalty of 5% on balances owing, and then they're going to add 1% on each month to a max of 12 months. So that's actually pretty expensive when you think about it. If you owe quite a lot of money, immediately, whatever you owe, they're going to charge you 5% on it, and then 1% on top of that each time. So that's definitely something to be aware of. And what also is imposed is if you're receiving benefits from them, this could impact your ability to receive benefits. The second consequence, aside from filing, if you pay late, interest rates are based on balances owing, and the interest rates change every 3 years based on a prescribed rate that they have defined. Okay? And again, this is where you can find that on their website. Lastly, if you file late, you pay late, and it gets dragged on, you can possibly face collections or legal actions. And they will send you typically notices of this. And the way that they've designed the system, ultimately, you're the one that has to be responsible for meeting their timelines. This is really important to understand. You cannot assume that you didn't know. They are going to impose it on you, assuming that you do know. This is, again, something to make sure you take away, and that essentially the CRA is certainly, so when it comes to your taxes, the CRA is certainly not someone you want to essentially owe money to and for an extended period of time. Not only is it expensive, but there are so many things they can do to negatively impact you. Now that we've gotten through the administrative components of taxes out of the way, let's start by understanding the way the system of taxation in Canada is designed today and how they deduct those taxes from the income that you've earned personally. The first part to recognize in terms of the structure, the Canadian tax system is a progressive system, which means low income earners are taxed at a lower percentage than higher income earners. The more you make, the more taxes you pay. Taxpayers pay income taxes to the federal government and to the government of the province and territory which and where they reside. What I'm going to share with you is an example of combined federal and Ontario tax brackets. What you see in front of you is an example of combined federal and Ontario tax brackets, including tax rates, including the surtaxes. Now, the other part to recognize is it's based on Ontario 2022 marginal combined and combined Ontario 2021. And what you can see here is based on the first, let's say 46,226, this is the approximate tax rate that you pay. And as you go up in income, you can see the highest tax rate in Ontario is 53%. Now, it's also segmented by the income types, by other income. So other income includes interest income and employment, capital gains, Canadian dividends, which is segregated between eligible and non-eligible, which I'll explain a lot in the later components of this video. But what's really important to then understand is you see how each of these taxes first attracts a specific tax rate. What's important to understand is based on the income level, this is where you generally will fall into. So this is the category. And then depending on the income type, it attracts a different tax rate. So for other income and employment income, that is 20.05 as an example. Capital gains is 10.03. Eligible dividends is a negative, and then eligible is about 9.24. So you can then compare and see that each income tax attracts a different tax rate. The implementation of taxes isn't so simple. So most of the concepts I will explain, I will use what's called marginal tax rates. The marginal tax rate is different from the average tax rate. Average tax rate is defined as your total taxes paid over or divided by your total income. So another important concept to understand with marginal tax rates is that for every dollar that increases in the particular bracket that you're in, that is the percentage of amount it would go to pay taxes. So let's actually just go through a real quick illustration just to give you an approximate idea for you to look at. So let's use an example here where I'm just pulling up a income tax calculator. And you can simply find one of these on the internet. I'd recommend that you choose one from a reputable source. And what's important to understand, though, is that these tax calculators aren't meant to precisely calculate the taxes that you would owe to the government, but it can be helpful for planning purposes for you to get an idea of the tax implications on the decisions you make when it relates to income. So let's kind of open an example and use that you have employment income of 100,000. So if we look at employment income in terms of that 100,000, the amount of taxes you would pay on that would approximate 27,084. And on that 27,084, you can see the average tax rate is really this number divided by the 100. So that achieves 27.08%. The next thing to understand is what this marginal tax rate is. This marginal tax rate means if you earn now from this $100,000, you earn an extra $100, $43.41 will actually go to taxes because you've now moved into another tax bracket. So this is really important to understand in terms of this quotation of average tax rate and marginal tax rates. The reason why marginal tax rates are used is because we have a very complicated system that is progressive. So the more income you earn, the more taxes you pay. Okay, so this is just to illustrate that point. Now, the first thing to now recognize is that this actually opens up a very important question. You receive more income, and you definitely feel great for receiving that income, but now it's really important to understand how you receive that extra income. The feeling of getting that extra salary bump, if it's a salary, may feel amazing. But if you look at the situation and the progressive tax brackets, in a way, you actually get penalized for making too much money. So let me kind of show you an example of what that looks like. So I'm just going to use an example of employment income. You normally receive 90,000. The appropriate taxes that you would be paying would be 23,443. Now, let me just kind of write that down for us to see. So what I just first wanted to put down are some of the facts of the scenario. 90,000 was the income that you earned. The taxes that is approximate is 23,443. So your after-tax income is 66,556, where the average tax rate is 26.05 and the marginal tax rate is 31.48. Now, let's assume you've got an extra bonus that has come in the form of another salary, a bonus income. Let's take a look at what that looks like. And let's say that bonus is 9,000. So you're now 99,000 in terms of income. And so after that 99,000, total taxes would be 26,650. Your after-tax income is 72,350. So your average tax rate is 26.92 and your marginal tax rate is 43.41. Let's look at the absolute dollars perspective. So on the dollars, you've got an increase of 9,000. Now, if we look at the average tax, we look at your average tax has increased 1%. And so that's a 3% change. And now if we look at your marginal tax rate has moved up 12% compared to your salary that has increased 9,000 or 10%, or in other words, the marginal tax rate, you've increased not only 12% more to pay, it's a 38% change, meaning you are paying more. So the increase in the marginal tax rate that you're paying far exceeds the income that you've increased on. And what's really important to understand is, of course, more income is nice, but now there's diminishing return for you because in essence, you are being penalized for earning more money. When you move into the higher tax brackets, taxes paid become excessively punitive. This isn't a simple solution, but you've got to consider whether or not it's actually beneficial for you. And it actually is not always your fault. You've worked hard, your companies or whoever you're working for is willing to pay you more, but now the system that you're working under is penalizing you for that hard work. And that system isn't designed in your favor. It's designed for the government's favor. The best times to evaluate opportunities in managing your tax bracket will come to a variety of factors, like what stage of life you are in, whether you are married, whether you have children, whether you have side hustles or other areas that need to be looked at and considered, which also include other income types. So let's dive into the next part. The next income category or income source that we're going to talk about is capital gains and maybe capital losses. Capital gains come from capital assets, and capital assets include items like stocks, cryptocurrencies, mutual funds, art, antique, collectibles, real estate, private investments, private businesses, and sometimes bonds. Now, this taxable event will trigger either what's called a capital gain or a capital loss. I used a very important definition here, which is the term dispose. The most common definition that most people understand in terms of dispose is when you sell it and you no longer have control over it. But it's important to understand that the tax code uses the term disposition. Other scenarios that can happen in your life, like when you are no longer a resident of Canada, or when you eventually graduate on this earth. The CRA has a term which they use, which is called deemed disposition. That definition is much more broader than what you think. And what deemed disposition basically says is that based on some event, like leaving Canada, Canadian residency, or death, that capital asset is considered sold for the fair market value, despite it actually not leaving your hands, meaning you actually have not physically exchanged the legal title of it. You would end up owing money to the government for that deemed disposition, and you would be forced to find the money in place to pay them. So despite you actually not even selling that capital asset, which normally people sell it to get the funds to pay the taxes, you actually would still pay the taxes if you still held on to it. During your working years, the most common money that is flowing into you, or at least where you start with, is employment income. And that is where, from what you have in your employment income, you are now moving that money into another category. And generally, you want to build up wealth. And when you're building up that wealth, it can be in many forms. And a very often neglected view is that you are working hard to accumulate your wealth in those years. And let's just say you've built a sizable stock portfolio or real estate portfolio. Whether you like it or not, one of the beneficiaries to your estate is the government. And they can have dibs up to 50% of the value of your estate. As you are earning money through employment, you are paying taxes for that. And as you deposit that money into some form of capital asset or investment, though you are not paying taxes for it, as that investment goes up and appreciates in value over time, and eventually when you start getting to your next later phase in your life where you are potentially going to graduate this earth, the government is going to tax you on the value of what you leave behind. Even though they have not taxed you on building it, they will tax you when you leave it behind. And what is often neglected is that the government wants to be paid immediately. Otherwise, you will be penalized, like I mentioned earlier, for those penalties and interest. And for most family, what ends up happening is that they have to liquidate those assets to satisfy the government's share for your success. So after watching the rest of this video, please make sure you check out my other videos on being taxed on your success when you leave this planet. And actually, this is where another component of becoming your own banker, how we design these systems, how it's properly structured, if it's properly structured, could mitigate the consequences on those taxes that you have to pay. A big part of what we do here at Ascendant Financial is to help you build your reservoir of wealth so that when it comes time, your family is not caught by surprises on that government success tax settlement. You will still need to pay it, but at least we can find different ways to mitigate liquidating specific assets. Now you have an idea of what capital assets are. Let's talk about capital gains, because that's the type of income that these capital assets can generate. So capital gains taxes were introduced in 1972, And prior to that, there was actually no tax on capital gains. And then there was a period in which Canadians had what's called a capital gains exemption for about $100,000. So meaning Canadians could each make $100,000 of capital gains tax-free, and anything above that 100,000 would be at a 50% inclusion rate. So here's an example. If you had some stocks that you bought for 50,000 and you held it for 5 years and it grew to 150,000 where you sold it, the gain would be 100,000. And under those old rules, all of that would be completely tax-free. Now, unfortunately, that doesn't apply today. Now, of course, there are a few exemptions like selling small business shares, farm property, fishing property, and your principal residence, which is the home that you live in. They are excluded from capital gains tax. Now, let's kind of look at what that inclusion rate looked like from the CRA. In the history that we can take a look at, we can see that capital gains exclusion rate and see that history there. So that history that we see is, so before May 23rd, 1985, it was a 50% inclusion rate. Afterwards, it was 50%. And then the next part you'll see is it increased to 66.67%. And then from 1990 to 95 is 75%. And then afterwards, it basically fell back to 50%. What I am trying to share with you here, and what you would have noticed, is during a very particular important period of time, especially during the 1980s, during that house collapse crisis and all these other inflation and interest rates when they were high during that history in Canada, capital gains rates actually increased. So where it used to be was 50%, where does that likely, again, your best guess where it can be, but what's really important to understand is just looking at the history and how the capital gains tax has been installed. Initially, it was installed being completely tax-free. Then they included the $100,000 exemption. And then they've increased the rate up to 75%. And then afterwards, they've retracted it. But, you know, we're kind of in a different economic time and very similar to some of the periods that you saw earlier in that history. Where could capital gains tax be? Your guess is probably as good as mine. There are also some important things to take a look at when it comes to capital gains and capital losses. Let's take a look at that. When it comes to capital gains occur when a taxpayer disposes capital assets. And oftentimes, the part that needs to be understood is the distinction between capital gains and business income, which I'll talk about later, is difficult to discern. The important part I want you to take away from what I just shared with you is that capital gains are taxable. So any increase in the value of the capital assets since you've acquired them, that's where there's some actually element of judgment involved, determining whether it is a capital gain or a business income. And this can be difficult to determine at times. What's important to understand is it's not dependent on the item like a property, rather it's each of the specified capital assets have rules attached to them when they may be considered business income instead of capital gains. And when it comes to the rules, the CRA will assess this sale by applying the rules on that asset, which are broadly open for interpretation. The principle behind it is to determine whether the asset you sold was used to help you earn income, or was that asset that you used the one that actually generated the income. The decision in which your sale of capital property will fit under the rules for capital gains or business income, that's going to attract different tax rates. So let's talk more specifically about the capital gains. The first and most important point to understand is, at least from what you've seen earlier in terms of the progressive tax table that I shared with you, capital gains are the most favorable income tax treatment. Capital gains and losses occur when a taxpayer disposes assets for proceeds for that fair market value. Proceeds, or that fair market value less the adjusted cost base, will create what's called a capital gain, where proceeds are greater than the ACB, or it'll create a capital loss when the proceeds, generally the money that you receive, is less than the cost that you paid for. Well, when it comes to taxable capital gains, this is defined as 50% of the capital gains. 50% of that gain from disposition will be added to your current income, which would place you in the appropriate tax bracket that may result in paying more taxes. Taxable capital losses are defined as 50% of the losses. Capital losses, this is the important part, can only be used on capital gains. And when it's used, it can reduce gains portion of your income to bring down your tax bracket so you ultimately pay less taxes. What's also important to understand is when it comes to that label capital losses, they can be saved indefinitely and be used at your discretion. So this only obviously makes sense if we walk through an example. Let's walk through an example where we're actually looking at the marginal tax rate table specific to other income. And so let's just say this individual earns, or you earn $100,000. You've had a property that you've acquired, one of the eligible items that fall under the definition of a capital asset, and the cost of it is $50,000. That is what we would call the ACB. And then the fair market value would be $150,000. That's what you sold it for. And so your gain here is $100,000. Now, not all of that $100,000 is actually included in your income. Your actual taxes you would end up paying would be $65,115. So let's kind of walk through that example. The $100,000 from your income is here. Your gain from your capital sale is here. So that's only taxed at 50%. So your actual income is $150,000 at 43.41%, because you see how this just hit the 150 mark. And so from the 150 mark, the tax rate applied is 43.41%, the marginal tax rate, and that was going to be the 65,115. Again, this is just using marginal tax rate, a simplified illustration of the taxes. The more accurate one would obviously be when you start filing your taxes and you use the CRA approved software during when you file your taxes. Okay. Now, in a different example, let's talk about how capital losses work. When it comes to the capital losses, your employment income is 150 and you acquired the asset at 50,000, and instead of making money on this, you sold it for 25,000. So you ultimately lost 25,000 on this transaction. And when you have this transaction, what's going to happen then is, if we look at your $100,000 in income, since this 25,000 is a capital loss, not in income, this is not allowed to be deducted unless you had capital gains to apply it to. So if we just look at the individual's income, or let's say your income in this example, the 100,000, we're going to take the 100,000, falls into this bracket, 37.91%. So times 37.91, that is what your taxes would be. You would need to save this 25,000 loss for in the future, where if you have a capital gain, like the example that I showed earlier, you can then take this 25,000 to apply against that capital gain. So we've just completed talking about capital gains and capital losses. Let's talk about another income type, which is now called dividends. And dividends actually fall into a couple of categories of eligible, non-eligible, and foreign. And also what you may not be aware about is capital dividends. Let's talk about the different types of dividends. When it comes to dividends, the first one is eligible dividends. And eligible dividends are paid by public Canadian companies and also Canadian-controlled private corporations that are paying income tax at the higher rate. So these are individual corporations that no longer qualify for the lower small business. When it comes to eligible dividends, they get taxed at more favorable rates at the personal tax level because the corporation paid the higher tax rate already. Assuming you have no other income sources, the federal government will allow you to receive about $63,000 and pay $0 in income taxes. Now, depending on the provincial government, which province you're located, you could pay anywhere from $0, or if you're in Ontario, then Ontario actually levies a starting tax of $750. And this actually increases as that eligible dividend goes above that $63,000. Now, this is extremely important, assuming you're actually holding these shares in an unregistered account, like those that are not, basically not an RSP, a TFSA, or a RIF. So when you receive that dividend, you would actually be taxed in the appropriate tax year personally. The second type of dividend is called a non-eligible dividend. And these are defined as all other dividends except for capital dividends. This includes small corporate businesses who earn the lower income, which is below the $500,000 threshold. And when they pay dividends, you personally will receive what's called a non-eligible dividend. And these are actually taxed at the higher dividend tax rate compared to the eligible dividend tax rate. Now, again, assuming you have no other income sources, the federal government will allow you to receive about $30,000 from a non-eligible dividend paying corporation tax-free. Just like eligible dividends, you could pay $0 in provincial taxes depending on which province you're located in, whereas in Ontario they will levy a minimum tax of about $750. Irrespective of that, you at least have an idea in terms of income. If you were to receive via a dividend, you would virtually pay much lower taxes had you received the equivalent in a salary or other income type. Now, another not touched upon topic that very few people actually understand when it comes to owning a business, there's actually what's called capital dividends. And these dividends are paid out of a capital dividend account out of a corporation. Some of the most popular items that get included into this capital dividend account are the non-taxed portion of that net capital gains, which we talked about earlier, that other 50%, and also life insurance proceeds. So upon death, those proceeds will be paid. If the corporation was the beneficiary, the proceeds would be paid to the corporation, which actually goes to the capital dividend account. And that capital dividend account basically is money that has been built up in this pool. And when you want to get money out of the corporation, this will be able to come out, most of it can come out tax-free, again, if this is done properly. Of course, this is a very advanced topic that if you are a business owner, you probably want to pay attention to, and especially if you're working in terms of now including this process of becoming your own banker, we also work on making sure you can optimize and take advantage of the capital dividend account. The last source of dividends that I want to talk about is called foreign dividends. And if individuals receive foreign dividends, then this is where you actually will not get favorable tax treatment. So the CRA actually gives favorable tax treatment to Canadian resident corporations, where essentially through specific what's called integration rules, there's ways that you can benefit from receiving the dividend income. This doesn't apply here. So foreign dividends are essentially treated just like interest income and other income, which are taxed at very similar marginal tax rates as those for employment income. This last one doesn't actually fall into a specific category of what I've shared earlier, but it's called business income. Actually involves structuring. And there's a little bit of some different rules that apply to it. And this is a step that actually happens before incorporation. And when you actually incorporate, there's a lot more advanced things that happen. When it comes to the CRA code, the way entities are taxed, generally, there are individuals, and then of course, there's corporations. Both are considered two taxable entities for the CRA. There are a few more to be considered, but not in this purpose of us talking about personal. The first and most important thing to understand is when you start changing the structure of how you are taxed, that actually introduces more complexity within the income tax code. And right now, our focus is on personal because most certainly the way corporations are taxed are different than the way individuals like yourself are taxed. Now, if you're running a business, whether that is a sole proprietorship or a partnership or a corporation, there's more flexibility in terms of deductions that can be taken. So basically, any reasonable business expenses incurred to produce the business income, that can be deducted. And when you deduct it against the income that it was generated from, this will reduce the taxes that you owe. And at the end of the day, as a sole proprietor, there is no distinction between the individual and the business. So you report your business income and expenses on your own individual tax return. Now, it's really important for you to separate what is your employment income and then what is your business income. And remember what I talked about, those forms, your forms will show you what your T4 income is, which is your employment. And for most of you, your business income, you're not going to receive any of the CRA forms, but what you're going to typically do is have your financial information captured in those very popular accounting softwares. And that's where you may have a bookkeeper who actually captures all of those transactions for you that gets summarized into financial statements, which you then pass to your accountant to file your taxes. Well, the common expenses of running a business include some things like expenses for your home office. Now, ultimately, you would pay for the mortgage insurance, electricity, utilities, internet, or phone expenses. But the benefit here is essentially you get to deduct a portion. And these are based on the rules by the CRA. And when it's deducted from your income, it's going to result in a decrease in how much income that ultimately gets calculating your tax liability to the government. Ultimately, by running a business, it opens the avenue or choices available for you to apply deductible expenses against that income so you can pay less taxes. Expenses generally that you incur should be supportable for you earning that income. You'd be eligible to deduct those expenses to ultimately decrease your tax bill. When it comes to the CRA, they are the ones who set the rules. And so there are actually some expenses that are not allowed for deduction, even though you incurred those expenses. An example of that is golf memberships. Even though potentially you may meet individuals at the golf club, you may going through rounds of golf, and you may have discussions and close business deals on the golf course. However, the CRA has a specific rule that is defined in there, and they do not allow you to deduct golf expenses for generating that income. Remember, these are the rules set by the CRA. The good part is, though, when it comes to having a business, generally, there's going to be some overlap in the expenses that you incur, and you have to be very clear in separating what is personal and then what is business in the cases of when you were to get audited. And in some cases, it's shared expenses that you would have already needed to occur as part of your day-to-day as an employee. But if you run it as a business and you incur these expenses to generate that income, now there's rationale for you to have it become deductible. Let's take a step back and look at when money is actually flowing into. And now let's look at what the difference is in terms of outcomes of how much taxes you pay and how it's actually defined. So let's walk through an example. It's relatively simplified just to illustrate a comparison. It's not meant to be precise, but it's just to give you an idea for your planning purposes and to open up a forum for discussion in terms of your personal circumstances. So the first thing we're going to look at is, let's just take an assumption of an easy number of $100,000. This is money that has flowed into you. And the other part is I'm just putting in here, making up a deductible or allowable expense, whatever you want to label it to be, but we'll call it an allowable expense of $10,000. Now, if we kind of look at the circumstances, if you were to receive that amount of income as employment, you won't be able to deduct that $10,000 that you see there. So that $10,000 is not deductible. That $10,000 that was an expense that you've incurred, you're not able to deduct it because it doesn't fall into the category or allowable rule for you to use it. So it's not deductible. So you're going to get taxed at $100,000. And using the tax calculator, you can see the distribution of federal, provincial, CPP, and the total taxes you would pay would be $27,085. The average tax rate is 27%. So what you actually have available after tax, the taxes that you've paid, is $72,915. Now, let's just say you received that income as a different income source. Let's say the next income source in the way that you received it is a business. So as a business, so let's say you receive the same $100,000 If you had any capital losses, you could actually use the capital losses against the income that you get from business. But in this case, there's no example, there's nothing there. And because this expense is deductible, the reason for it being deductible is used to generate income. My income for tax purposes has now gone down. So now if I apply that same calculation, again, this is not under a corporation. This is just as like a sole proprietorship, which therefore still falls under personal tax rates. You're going to pay $14,000 in tax, 7.5 in provincial, 633 in CPP-EI, and then their tax credits is 28,000. So you can see there is a slight change in the amount of taxes that you're paying here. Now, what's really important to understand though is when you are using business income, you're going to notice the CPP and EI increase. And this is just under the assumption that this individual just receives completely sole proprietorship income. Nuances, which if you normally CPP and EI is actually shared between employer and employee. Well, if you are completely a sole proprietor, you have nobody to share it with. There is no employer making that share in terms of those deductions. So that's why that's higher there, which ultimately you can see as a business, you will still pay potentially higher tax rates. The only thing is you get to deduct expenses that are eligible. So again, this is just something to keep in mind in this example. So both of these categories, what's actually important to also recognize is that this is what's called active, meaning you actually are exchanging your hours and your expertise to generate that income. It's active for you. Now, in terms of the CRA, they have what's called passive. So let's kind of look at the first passive category. The first category that we talk about is that capital gains. And if we look at the capital gains, your cash flow has come in as $100,000 in the form of capital gains. So now when we apply that tax rate, we can actually see on that $100,000, the amount of taxes paid federal, taxes paid provincial is only $8,258. And so you can see just from an average tax standpoint, it's about 8%, which is significantly lower than these other options. So your disposable income is now $91,742. So you can see just compared to these three options that we shared with you, if the income source you receive, that same $100,000 comes in the form of capital gains, you have received a very, very favorable tax treatment. Now let's move to the next category as if you were to receive it as interest income and other income. So it's not just interest, but it's other income. So if you were to withdraw money out of your RRSP, it would actually fall into this category also. But similarly here, you will see of that $100,000, 15,000 goes to federal, 8,000 goes to provincial, total is 24,000, and the average tax rate here is 24%. So that leaves you with 75,796. And clearly the biggest difference here is if this is coming in the form of interest, you're not responsible for paying your share of the CPP and EI. So that is not included in looking at the tax burden that you have. The next and final one is talking about dividends. So that first dividends we're talking about is that eligible dividend. So if the income source that you're receiving in this example of 100,000 comes in the form of an eligible dividends, we go through that, then the tax that would come from that would be almost 5,000 and provincial would be 1,180. So the total taxes would be 6,173, which is around 6%. The next dividend when it comes to Canadian is what's called non-eligible. So of that 100,000 that's received as non-eligible dividends, this is where the taxes that would be paid would be 9,356, and then provincial would be 7,541, and the total taxes that we pay 16,897 for an average tax rate of 17%. The last income source, if you were to receive it, would be capital dividend, and this is if you were to receive it from a corporation that you own and it's being paid out of your capital dividend pool. You can essentially get this paid out tax-free. Again, properly designed, properly structured, you would generally pay $0 in taxes. So let's kind of review this whole summary that I've prepared in front of you just to kind of compare all of these income sources and the treatment as it relates to tax. If we were just to look at the ranking of the amount of taxes that you would pay for this, capital dividend is, of course, the most favorable. Then eligible dividends would be number 2, and capital dividends would be number 3, non-eligible number 4, then interest number 5, employment, and then business. Now, this ranking here isn't exactly always the case. Circumstances to particular individuals can be different, and that could change that result. But from a understanding overall in terms of the income types, this is what you want to be able to see in a general viewpoint if you have the choice to receive the income that can impact the amount of taxes that you pay. The whole point here is to recognize that different income, the way you receive this 100,000, depending how it's received, will result in specific tax liabilities that you are going to be paying. So now you actually have seen a comparison between the income types after going through the different types that you can receive for income. The next step to then look at is when should you prompt to evaluate your tax circumstances? Well, let's kind of take a look at that. These include when you have marital status changes, job changes, health changes, education, children, childcare, relocation, income sources. So now you can kind of get an idea of when that would happen. So if I were just to quickly go through them, obviously if your marital status changes, you may now have the ability to split your pension or qualify pension amounts, share medical expenses, donation contributions to your partner. And this could actually design and allocate it in a way that best helps both of you pay less taxes. If you are divorced, though, you are no longer able to share in those same items. There also may be changes in terms of childcare dependence and caregiver credits based on child custody and dependence in that home. Let's look at if you go through job changes. When your income decreases, you may find that you qualify for certain non-refundable tax credits, and that would lower your tax burden. If your income increases, you may find yourself the HST rebate, for example, that you're going to get is going to be a lot less, as is your Canada Child benefit. When it comes to health changes, your health or other health of someone you care about might result in an increase in the need of medical care or even disability support. And when it comes to medical expenses, there are many things that the CRA will allow you to submit as an expense, even as an employee. Now, if you had a loved one who's become disabled or seriously ill and are now relying on you for care, physical or financial, this could actually impact the amount of taxes that you pay because they would give you a relief around that. Now, when it comes to education, did you or your child head off to post-secondary school in the last year? If so, the federal government gives what's called a tuition credit. You are able to now apply that to your taxes and lower your taxes for that if your child doesn't need to use that deduction. So that there's a credit that is there that will allow you to pay less taxes, and who it's applied to, it can be actually transferred to you instead of them using it themselves. Then there's children and childcare. Did you adopt a child, or when is the last time you went to work or school? These are, again, some circumstances that may be eligible for deduction depending on your personal circumstances. Lastly, if you've relocated or maybe because of a job promotion, if you move somewhere at least 40 kilometers closer to your new location, you may be eligible to claim your moving expenses. And again, this could be used to help apply against lowering your tax burden. Let's go through and summarize everything that we've gone through in terms of this video. When it comes to building and keeping wealth in your family, you must have an assessment of the outflows as well as the inflows of your money. Particularly when it comes to taxation, what you want to know is that the function of income taxes, it comes from the government as a source of revenue to them. It was initially introduced as a temporary measure, which then became a permanent measure. So if you assess the context of the situation and the benefits, what are the probabilities that when you're planning how you are building your wealth, whether the measures that you're putting in, is that going to be an issue in the future? Because remember, the temporary measures could become permanent. Income taxes are controlled by the government. And when we take a look at the past, one of the things we want to always look at when the government makes changes is what changes have they moved to? Has it become overreaching compared to before, especially when it's after elections, budget pronouncements, and other surprise announcements? You want to understand where the emphasis of focus will be on income taxes. Since the inception, tax rates have been steadily increasing over time, and the scope of what falls into the Income Tax Act have also increased, and the rules have changed in favor of including and paying more taxes. What you've also known is that different income sources will attract different tax rates, and you'll have to apply different rules. So one of the things you want to look at is making sure it fits the appropriate category, because changing the category of income can also actually enhance your tax minimization plan. This should be discussed with your tax professional, especially where you have changes in your personal circumstances, and this should always prompt a discussion with your tax professional. Your tax professional is ideally someone who has a strategic point of view that can see the long range and adapt them to your personal circumstances. Your tax professional, generally, you can consider them a strategist for your taxes, is someone that is on your team who is ideally open to collaborating with other professionals. Everyone has different skills, and it's really important that you find ones that have the ability to be open to collaborating with other professionals to help you achieve your goals and objectives. When it comes to taxation, the government's going to make sure that they will get their fair share of your work. Either you're going to pay it today or pay it later. And of course, if you know more about how the system works, you'll be able to manage your personal circumstances much more effectively for tax efficiency. And one of my favorite pages in terms of Nelson's book, Becoming Your Own Banker, Nelson says the government, lawmakers, and bureaucrats who carry out these perversions of law fully understand that they are dealing with a parasite-host relationship. Government is not capable of producing anything. It gets all of its sustenance from the productive elements of society. The government is a parasite and lives off of the productive taxpayers who are the host. It is self-evident that if the parasite takes all the produce of the host, then both parties die. Government officials may be cunning, but they are not stupid. I'm sure that if Nelson were here and I were to be able to meet him, it would be such an honor for me to meet him. All I would just say is, when it comes to taxation, congratulations on making it this far. What you've learned here was just the beginning of when it comes to income taxes. The next steps actually for you would be to learn how to structure the cash flows as it moves in and out of your life, the assets, your liabilities to match your life objectives and the stages of your life. And this is where, if you really want to learn more about this concept, especially building wealth in a tax advantage friendly environment, I really would encourage you to visit watchibc.com to get more information. When we look at the current tax system, it's been in effect for over 100 years. And you can say that's more than 3 generations. I'm not here to influence any opinions, but I just want to leave you with some thoughts for you to consider. Unfortunately, when it comes to the income tax system, I can't speak for the generation before me and the events that occurred during that time when the system was proposed as a temporary measure for World War I, which then evolved to become a permanent measure after World War II. At those periods of history, it was a crisis of war that had high government spending with the creation of high government debt and high inflation. Now, here are some important things to understand. When this system was installed, the Income Tax Act, when it was permanently installed, was very simple and straightforward to calculate. When I go back to the historical documents that I own, it was actually very simple. It was 21 pages, simple font with 4,000 words, which is very close to our Becoming Your Own Banker book here. That's only 92 pages, but nonetheless, today, when it comes to the income tax system and the Income Tax Act, that system has evolved into an incredibly complicated system with over 1 million words and nuances where you actually need to hire tax professionals, tax lawyers, tax specialists just to advocate for your position. Furthermore, there's penalties, fines, and interests, and these can be extremely punitive. From when it used to be since its beginning, you probably agree with me that this system is here to stay, and there's very little that you could do to remove it. Could you actually imagine removing this system? I mean, maybe it can be transformed, but what would that even look like? How likely is that going to happen? And one of the important things I want to share in terms of the history, and if we were to draw patterns from that history, as if we were to look back at when the income tax system was installed in Canada, this was after a series of war, and the only notable measure the government had prior to monetary policy and printing money was increasing taxes to cover the shortfall for all of the spending that happened in the past. Unfortunately, there's limited information available for Canada, but a good look to our neighbor in the US, when we look at their tax brackets in the history, they've jumped from 15% to 67% after World War I and dropped to 25% until the Great Depression. From that Great Depression of 1932, tax rates increased on the top earners from 25% to 63%, and even at some point jumped to 94%. So what you can kind of say is, if we look at Canada in terms of income taxes, the current highest marginal tax bracket is 53.53%. Now, these taxes do pay for different services that our US partners down there don't have, but irrespective of that, it's important to recognize as a burden to you, it's becoming quite heavy. Now, I also don't want to downplay the current events that are going on, and I'm not trying to attribute any motivations, but I just want to state that it's been 100 years since the tax system has been implemented. If you take a look at the economic patterns and history today compared to 100 years ago, it draws quite a few parallels to where we are today. And that has resulted in the government spending a lot of money with the creation of high government debt and the high inflation. If we project this forward to the next 100 years or similar 3 generations, meaning your current generation, your children and your grandchildren and your grandchildren's children, with the tools that the government has, what is likely going to happen to income taxes? What they are most likely in position to do is to increase them. And we're going to walk into the same hyper penalizing taxation rates that will impact your retirement, your children's prosperity, and your grandchildren's prosperity. And as Nelson would say, when taxation becomes onerous to the point where government officials sense rebellion, they always resort to exceptions to the rule. Unfortunately, I, like many of you watching this video, was born into the system where I had no voice or any area to impact the implementation of the income tax system. Now, I'm of the opinion that taxation as a system is important to exist at some level. However, citizens should have the ability to block or reverse the complexity that it's gotten to, and especially the actions and the scrutiny that how they spend their money needs to be properly looked at. I wonder if the CRA officials themselves understand and know the nuances that the system has gotten to. I mean, you may get to voice what policy choices happen within the system, and every political party will provide a platform on what they promise, but how much of it actually adjusts and executes in your favor is quite debatable. What I hope to have showed you in this video is that there are actually opportunities for you to laterally, at least as long as you stay within the system, it's going to be legal. That is how you can optimize your personal tax efficiency. Now, could there be changes that would eliminate those areas? Of course, they set the rules. Could they start taxing your principal residence? Could they start taxing and working on what you've held in your savings more aggressively? Of course. Only time will tell. We're all going to need the use of money over our lifetime. And it's important to understand how much of that money is flowing into us that is actually ours. I think we see that the taxation system takes away a large chunk of that. If you look at the role of taxation in society, it's designed apparently to capture your fair share. And the government is supposed to be the custodian that we entrust to redeploy it into society that is best for society. In other words, your or other Canadians' lives. A very important question to keep at the front of your mind is that, could the system get any worse than it is today? And I wouldn't think you'd be surprised if I said it could. How much worse can it get? Well, time and your ability to exercise your freedom of choice and expression is what can delay or change that. Remember, our ancestors fought for those freedoms. Today, we're walking into what you may call or say a digital revolution. When it comes to how banking is working and how the cooperation with government is happening, what I wanted to show is a video showing from the Canadian Bankers Association how they claim that digital IDs can help consumers navigate between these applications and programs with trust and confidence. And it's being sponsored and agreed by the World Economic Forum. And in here, it says the World Economic Forum agrees banks should lead the digital ID. It's regulated and trusted and advanced cybersecurity and privacy technology and infrastructure. I mean, I'm for sure going to say that when it comes to presenting the benefits, they would for sure make sure that the benefits are properly explained for people to understand. But I think it's really important to understand how it actually can carry out. With that digital revolution, the ID system is essentially a global collaboration with the World Economic Forum, and it could evolve into being managed by some global governing party who may likely have access to what it is that you do and may have access to control what you are eligible to do and not do. This global governing party is not someone we would have elected. What you want to arm yourself with is knowing how much does this system actually benefit you? Where are the elements of control and who has the power in the system? And where are the safeguards to that overpower and overreach? How can it be reversed? At worst, what could be done and exploited against you? Remember, think about the impacts to your next 3 generations. Do you want them born into an evolved version of the income tax system? This is the question that I'm going to leave with you. There's so much that was covered in this video, and I want to make sure that you go through and actually watch it again and break it down into smaller chunks for yourself so that you can digest and understand. Ultimately, this is the income tax system. It's here to stay. How can you best take advantage of optimizing your tax efficiency when it comes to the current system that we're in? And you're supposed to look at that from your current circumstances, but also what the future entails. Please make sure you like this video, add comments below if you want to know more, and please check out the rest of our channel for more videos. I'll catch you soon.